If you already have $100,000 invested, the hardest part is behind you. Most people think growing that amount into $1 million takes high risk or a stroke of luck, but that's not true. There's an invisible force working quietly in your favor, the same one Einstein famously called the eighth wonder of the world. Once you understand how it compounds, you'll realize each dollar can become a small worker multiplying your wealth automatically. In this video, you'll learn how to activate that invisible engine and make the shift from saver to wealth builder, starting with why reaching $100,000 is the real turning point. Reaching your first $100,000 is often the toughest part of the wealth building journey. It's not because the math is complex, but because progress feels painfully slow in the beginning. This stage tests consistency more than strategy. You save, you invest, and yet the results seem underwhelming. Earning even a reasonable return hardly moves the needle when the balance is small, and that disconnect causes many people to give up before the real growth begins. In the early phase, nearly all progress comes from your own contributions. Every deposit makes a visible difference, but the returns feel almost invisible. It's the stage where wealth building feels like manual labor, steady but slow. Raising your balance from $10,000 to $50,000 can take years of careful saving, and most of what you see is simply what you put in. Compounding hasn't yet built momentum, so your results feel more like discipline than acceleration. This lack of visible payoff discourages many savers who question whether the system actually works. But something important happens at the $100,000 mark. That's when your money finally reaches a scale where compound interest begins to pull noticeable weight. With today's Treasury bill rates near 4.5%, a $100,000 investment earns roughly $375 each month in passive income. When that $375 is reinvested, it's added to the principal, which means next month's earnings are slightly higher. Over time, that process quietly builds on itself, an automatic loop, increasing your capital without any new savings on your part. At this level, compounding stops being a theory and starts showing results. What once relied entirely on your effort now begins to operate independently. It's the financial equivalent of pushing a heavy cart until it starts rolling under its own momentum. The more capital you have behind you, the more that momentum turns into measurable financial movement. Instead of each small return feeling negligible, you notice that the numbers now move whether or not you make additional deposits. To see why this point matters, consider the timeline of growth. Suppose you're earning a 10% annual return. Growing from $50,000 to $100,000 might take around 7 years. Reaching $200,000 from there takes about the same 7 years, but the gain is twice as large. Another 7 years turns $200,000 into $400,000, representing an even bigger jump. And the next doubling produces an even more dramatic lift in absolute dollars. The time frame stays mostly consistent, but the dollar outcomes increase with every cycle. That's the quiet acceleration at work, and that's what most investors never experience because they stop before compound interest becomes powerful enough to notice. Reaching $100,000 is also when your relationship with money starts to shift. Up until now, you've been focused on saving, cutting costs, setting aside income, and building your base. But once you have a six-figure investment balance, you begin to think differently. You start evaluating how well your capital performs rather than how much you can store. Your focus moves from protection to productivity. You stop seeing your savings as something static and start viewing it as something active, an asset that generates its own income. This mindset change may be the most valuable outcome of the milestone. When you frame every dollar as a small employee earning returns, you gain patience and confidence in long-term growth. You begin trusting the process rather than chasing shortcuts. At that point, compounding transforms from an abstract concept into a working system, quietly multiplying your wealth. Once this shift takes hold, the next stage isn't about saving harder, it's about understanding the invisible force that makes your money grow on its own. Albert Einstein once referred to compound interest as the eighth wonder of the world, a force so powerful it can quietly turn patience into wealth. Unlike most strategies that demand constant action, this one grows on its own. Once your investments reach meaningful size, each dollar begins producing smaller returns that, when reinvested, feed back into the system. Over time, those small gains expand automatically, creating a form of financial momentum that works whether you're paying attention or not. Take a $100,000 portfolio earning a 4.5% annual return. That's about $375 a month in passive income. If you reinvest those earnings instead of withdrawing them, your principal increases, which in turn generates slightly larger returns the following month. The process continues, a steady compounding rhythm where interest earns interest. You don't need to calculate the exact dollar to understand what's happening. Growth builds quietly, then accelerates noticeably once the base grows large enough to let the math take over. The real magic lies in how compounding speeds up. In the early years, returns appear minor and progress feels slow. But each year's gains expand the base that produces the next round of returns, and before long, the numbers climb more quickly. At a 10% annual return, money roughly doubles every 7 years. That simple rhythm shows how investing time becomes just as powerful as investing capital. After several cycles, the total climbs exponentially, not because the returns changed, but because the compounding engine had time to gather momentum. Now consider what happens when two investors start equally but take different approaches. One reinvests every dividend and bit of earned interest. The other spends those profits each year. At first, their balances look similar, and the difference feels trivial. But over decades, the compounding investor's growth far outpaces the others because every reinvested gain creates future gains of its own. The habit of reinvestment, not luck or timing, determines who ends up with significantly more wealth. Economists call the outcome difference between them the compounding gap, and it's entirely behavioral. The challenge is that our minds aren't naturally wired to comprehend this type of growth. We're comfortable thinking in straight lines. Adding 10 feels like adding 10 again. But compounding multiplies instead of adds, which means its effects start almost invisibly and then rise sharply later on. Psychologists refer to this bias as exponential growth blindness. It explains why so many investors lose confidence early on. They see slow initial progress and assume the system isn't working. What they're missing is that the early phase is laying the groundwork for everything that follows. Without that foundation, the later acceleration never arrives. One way to make this concept more tangible is to think of compound interest as an invisible workforce. At first, only a few employees are on the job, each generating a small bit of profit. But whenever a profit is reinvested, it effectively hires new workers. None of them ever leave, all keep contributing, and together they produce increasingly large results. After enough cycles, your roster grows so large that the returns accumulate faster than your own efforts ever could. That's the stage where money truly works for you. Once you recognize this dynamic, your role as an investor becomes clearer. Compounding doesn't respond well to constant tinkering or emotional decision-making. It thrives under consistency, when reinvestment happens automatically and time is allowed to do its work. The key is creating a structure that supports this process, ensuring your capital keeps compounding smoothly while protecting it from unnecessary risk. And that raises the next question. How do you build a system strong enough to keep this engine running efficiently for decades to come? A strong wealth engine isn't built on guesswork, it's built on structure. That's where the 30-50-20 portfolio framework comes in. It's one practical approach, Not the only one, but it provides a clear foundation that balances safety, growth, and income. The goal isn't chasing the highest return or predicting markets. It's creating a system that compounds reliably through different economic cycles while protecting your progress. In this framework, about 30% of your portfolio goes into fixed income. This is your financial stabilizer, the part that cushions your wealth when markets shift. It can include Treasury inflation-protected securities, or TIPs, along with certificates of deposit. TIPs adjust automatically with inflation, preserving purchasing power even when prices rise. CDs offer predictable interest and guaranteed principal, providing near-term security. A mix of short and medium-term bonds keeps flexibility. Shorter durations adapt faster to rate changes, while longer terms lock in better yields. With rates still around multi-year highs, this side of the portfolio now offers meaningful income without taking on extra risk. The next 50% drives growth through dividend-paying equities. These are high-quality companies with solid balance sheets and consistent dividend histories. Aim for stocks paying above 3% annually, enough to generate real income while still allowing capital appreciation. The steady payouts feed your compounding cycle when reinvested, quietly increasing your share count and future income potential. Unlike speculative stocks that rely purely on gains in price, dividend equities reward time and patience. When companies raise their dividends, your recurring income grows automatically, even if you don't add new money. Over years, those reinvested dividends can account for a huge share of your total returns, powering your portfolio no matter how markets behave month to month. The final 20% belongs to real estate investment trust, or REITs. They bring a valuable layer of diversification because real estate tends to move differently from stocks and bonds. REITs also pay attractive yield, often above 6%, and distribute income monthly or quarterly. Those regular payouts create dependable cash flow that you can reinvest back into the system or use strategically as passive income. This allocation gives you exposure to tangible assets, apartment complexes, data centers, healthcare facilities, and more, without the management stress of physical property. Even when interest rates shift or markets turn volatile, that continuous income stream keeps working, smoothing your overall performance. The reason this 30-50-20 mix works so effectively is balance. Each component offsets the weaknesses of the others. Rising rates may pressure equities, but fixed income adjusts through tips. A cooling bond market might drag returns, but dividends and real estate distributions keep capital flowing. Inflation, which erodes cash value, often boosts REIT income as rents and property values rise. Together, these interactions create a portfolio that adapts, one that lets compounding continue uninterrupted even when conditions change. Many investors break this balance by leaning too heavily on one side, either pursuing growth at the expense of stability or hoarding safety while missing long-term upside. The framework protects against those extremes. It's not a rigid recipe, but a guide for keeping proportion and perspective. As markets evolve, allocations can be nudged slightly without dismantling the structure. The key is not perfection, it's consistency. In today's environment, where Treasury yields hover around levels unseen for years, and dividend and real estate income remain attractive, this structure functions like a coordinated engine. Every reinvested dividend, bond coupon, and REIT distribution becomes fuel for the next round of growth. You're no longer relying on new savings alone. The portfolio itself generates continuous inflows that compound automatically. Over time, that rhythm of reinvestment turns diversification from a concept into a real working system. But even the best framework can fail if it's not managed with discipline. The next critical step isn't about what you own, it's about how you behave. True long-term success depends on automation, discipline, and the willingness to stay committed when motivation fades. The market will always swing, headlines will shift, and uncertainty will surface, but those aren't what threaten your progress most. The real risk lies in the small emotional reactions that interrupt your plan. Skipping contributions because the market feels unstable or selling after a short-term dip weakens your compounding foundation. Each pause in consistency resets momentum, delaying results by months or years. Wealth is not lost through numbers, it's lost through hesitation. Emotional discipline matters more than prediction. Markets eventually recover. Investors often don't. The data is clear. Missing just a few strong market days can drastically reduce long-term returns. Your portfolio doesn't register fear or optimism. It responds only to time and steady input. When you turn savings into a reflex instead of a reaction, you remove the single biggest obstacle to compounding success. Emotional control can't stop volatility, but it ensures volatility works in your favor instead of against you. That's where automation changes the game. Automating your investments keeps progress moving whether you feel confident or not. When contributions transfer automatically from your checking account to your investment portfolio every month, decision-making disappears. It becomes mechanical, a routine that continues regardless of mood. Setting up automatic transfers and dividend reinvestment plans takes minutes at most brokerages, but the payoff lasts for decades. Every automated deposit strengthens your compounding cycle because you're always adding new capital even when market sentiment turns negative. Think of automation as paying yourself first, a fixed cost that funds your future. Schedule it alongside rent, utilities, or insurance. When investing becomes a non-negotiable expense, compounding continues uninterrupted. For example, $1,000 automatically invested each month builds far more over time than irregular emotion-driven deposits. The power lies not in the amount alone, but in the consistency and timing of every contribution. Automation removes the temptation to pause and keeps your wealth engine running at full capacity. Automation also extends to reinvestment. When dividends or bond interest flow back into your portfolio automatically, you avoid idle cash sitting uninvested. Those reinvested earnings buy more shares when prices are lower, boosting your long-term return. This mechanical process ensures that the invisible force of compounding never stops, even when you're not actively managing it. Discipline complements automation. It's about sticking to a schedule rather than watching the screen. Set your plan, then check in only at specific intervals. A simple approach is to review your portfolio twice a year, every 6 months. This regular but infrequent cadence allows you to make meaningful adjustments without overreacting to short-term volatility. During each review, rebalance your allocations back to their 30-50-20 targets. This practice enforces healthy investing habits, systematically trimming winners and adding to lagging assets before the imbalance grows. Staying disciplined also means considering the quiet eroders of wealth, inflation, and taxes. A portion of your fixed income in Treasury inflation-protected securities helps preserve real purchasing power, while being mindful of tax implications ensures compound growth isn't lost to avoidable drag. Being disciplined isn't just about resisting panic, it's about aligning every part of your system to protect and extend compounding efficiency. When you combine automation and discipline, investing transforms from a series of emotional choices into a predictable process. It shifts from if to when. Each deposit happens regardless of the market, each reinvestment happens on cue, and each review strengthens the structure that keeps it all compounding. Over time, the quiet reliability outforms even the most sophisticated strategies dependent on timing. Financial success doesn't happen by accident. It comes from planning, discipline, and consistent action repeated over years. Every automated transfer, every reinvested dividend, and every semi-annual review represents a step in that plan. Markets fluctuate, but the investor who stays methodical ultimately captures the full reward that compounding offers. As your system continues working quietly in the background, depositing, reinvesting, rebalancing, the next stage is about maintaining that steadiness as your balance grows. Because once time and consistency start working together, the invisible force behind your success becomes unstoppable. The next step is simple. Turn what you've learned into motion. Compound interest rewards time, consistency, and the discipline to stay the course. Every contribution, every reinvested dividend, and every calm decision strengthens the system you've built. Now is the moment to act. Open your investment account if you haven't already, or review your current one and automate your monthly transfers. Treat them as mandatory bills to your future. This is where the mindset shifts from saver to wealth builder. You've climbed the hardest part, and from here, the momentum builds naturally. Financial freedom is closer than it looks. All it needs is steady continuation.